Let's talk about debt, baby. Specifically, America's massive debt. It's a topic that often gets swept under the rug, but it's crucial to understand the dynamics at play here. We're talking trillions of dollars, folks. That's a number so large it's almost impossible to comprehend. Imagine stacking dollar bills. You'd reach the moon and back multiple times. And for years, China has been a major creditor, holding a huge chunk of U.S. Treasury bonds. These bonds are essentially loans to the U.S. government, and China has been one of the biggest lenders. Imagine a giant IOU from Uncle Sam, and China's holding a big chunk of it. This IOU represents a significant portion of America's debt, and it's a crucial part of the financial relationship between the two countries. Why? Well, it's been mutually beneficial. The U.S. gets to borrow money at relatively low interest rates, and China gets a safe place to invest its vast foreign exchange reserves. China buys U.S. debt, which helps keep interest rates low in America. Lower interest rates mean cheaper loans for businesses and consumers, fueling economic growth. This allows the U.S. to borrow more money, which it spends on, well, everything. From infrastructure to social programs, military spending to scientific research, the list goes on. This spending spree fuels demand for Chinese goods, boosting its economy. It's a cycle where both nations benefit. The U.S. gets the funds it needs, and China gets a robust market for its products. It's been a cozy arrangement. Both countries have enjoyed the fruits of this financial symbiosis, creating a unique interdependence. But like all good things, this relationship might be coming to an end. The dynamics are shifting and the future is uncertain. China's been steadily decreasing its holdings of U.S. debt. This isn't just a minor adjustment. It's a significant change that could have far-reaching implications. It's like they're slowly sliding that IOU back across the table. This move signals a shift in strategy and priorities for China. Now, before we dive into the reasons why and what this all means, let's understand one thing. The global economy is a complex beast. It's a web of interconnections and dependencies that can be hard to untangle. There are a lot of moving parts, and predicting the future is like trying to nail jelly to a wall. The variables are numerous, and the outcomes are uncertain. But that doesn't mean we can't try, right? By analyzing trends, data, and expert opinions, we can make educated guesses about what might happen next. So buckle up, Buttercup, because we're going on a wild ride through the world of international finance. It's a journey filled with twists and turns, and it's bound to be an eye-opener. So why is China cooling on U.S. debt? This is a question that has been on the minds of many economists and financial analysts around the world. The relationship between China and U.S. debt has always been a complex and multifaceted one, influenced by a myriad of economic, political, and strategic factors. Well, there are a few reasons. To understand this shift, we need to delve into the underlying dynamics of China's evolving economic strategy and its broader implications on the global financial landscape. First, China's economy is not the debt-fueled growth machine it once was. Over the past few decades, China has experienced rapid economic growth, largely driven by massive investments in infrastructure and manufacturing. However, this model has led to significant levels of debt and environmental degradation. They're shifting towards a more sustainable, domestic consumption-driven model. This means focusing on improving the quality of life for their citizens, boosting domestic demand, and reducing reliance on exports. Think less made in China, more bought in China. This shift is not just a slogan, but a fundamental change in how the Chinese economy operates, aiming for a more balanced and resilient economic structure. This means they don't need to buy as much U.S. debt to keep their export engine humming. In the past, China bought U.S. debt to stabilize its currency and support its export-driven economy. But with a stronger focus on domestic consumption, this need has diminished. Second, China's got its own financial goals. The Chinese government is increasingly focused on achieving financial stability and reducing systemic risks within its own economy. They're pouring money into ambitious projects like the Belt and Road Initiative, which we'll get to later. This initiative aims to enhance global trade routes and strengthen economic ties with other countries. This global infrastructure project is like a modern-day Silk Road, and it requires a lot of cash. By investing heavily in these projects, China hopes to create new markets for its goods and services and secure its economic future. China's also diversifying its foreign reserves, moving away from the US dollar and investing in other assets like gold. This strategy is part of a broader effort to reduce dependency on the US economy and mitigate risks associated with holding large amounts of US debt. It's like they're putting their eggs in different baskets, just in case one basket decides to grow legs and run off. By diversifying their investments, China aims to build a more secure and resilient financial future, less vulnerable to external shocks and uncertainties. Imagine a network of roads, railways, ports, and pipelines stretching from East Asia to Europe, Africa, and beyond. That's the Belt and Road Initiative, BRI, China's grand plan to boost trade and connectivity across the globe. It's like a massive infrastructure project on steroids, and it's sucking up a lot of China's capital. The BRI is a long-term strategic move by China to strengthen its global influence and secure access to resources and markets. It's also a way for China to put its vast foreign currency reserves to work. Instead of buying U.S. Treasury bonds, China is investing in infrastructure projects that could yield long-term economic and geopolitical benefits. China isn't alone in its quest to reshape the global financial order. It's part of a group of emerging economies known as BRICS: Brazil, Russia, India, China, and South Africa. These countries are tired of the U.S. dollar's dominance in global trade and finance, and they're looking for alternatives. BRICS nations have been promoting the use of their own currencies for international transactions and creating their own financial institutions, like the New Development Bank, as an alternative to the World Bank and the International Monetary Fund. This move away from the US dollar could further reduce demand for US debt. Section 5. The allure of gold: China's growing reserves. Remember that saying, gold is a safe haven? Well, China seems to be taking it to heart. They've been steadily increasing their gold reserves over the past few years. Gold is seen as a hedge against inflation and a store of value, especially during times of economic uncertainty. By diversifying its reserves and holding more gold, China is reducing its exposure to the US dollar and potentially weakening the dollar's dominance as the world's reserve currency. It's like swapping out some of your dollar bills for gold coins, just in case the dollar goes the way of the dodo. Section 6. The fallout. What happens if China dumps US debt? Now let's address the elephant in the room. What happens if China decides to sell off a significant portion of its US debt holdings? Well, it's not going to be pretty. First off, it could trigger a sell-off in the bond market, driving down bond prices and pushing up interest rates. Higher interest rates mean more expensive borrowing for everyone: businesses, consumers, and even the US government itself. Imagine trying to get a mortgage when interest rates are through the roof. Yeah, not fun. This could slow down economic growth and potentially lead to a recession. It's a classic case of supply and demand. If China dumps a lot of US debt on the market, the price goes down and the yield, interest rate, goes up. Section 7. A ripple effect, global market impact, and investor behavior. The impact of China's actions wouldn't be confined to the US. The global financial system is interconnected like a giant spider web. A shock in one part of the web can be felt throughout the entire system. Other investors might get spooked by China's move and start selling their US debt holdings as well, exacerbating the situation. This could lead to a flight to safety, with investors pouring money into safe haven assets like gold, Swiss francs, and Japanese yen. This could further weaken the US dollar and create volatility in currency markets. Section 8. The everyday impact. How this affects you and me. Okay, so we've talked about bond yields, currency fluctuations, and global market instability. But how does all this highfalutin financial jargon affect you and me, the average Joes and Janes of the world? Well, in a nutshell, it could hit us where it hurts, our wallets. A weaker dollar means higher prices for imported goods, from clothes and electronics to food and fuel. Higher interest rates mean more expensive loans, making it harder to buy a house, a car, or even finance a college education. And a slowing economy could lead to job losses and lower wages. Not exactly a recipe for a good time. Section 9. The future of finance, a shifting landscape. So what does the future hold for the US dollar and the global financial system? This question has been on the minds of economists, policymakers, and investors alike. The financial landscape is undergoing a significant transformation, driven by a multitude of factors including technological advancements, geopolitical shifts, and changing economic dynamics. Well, one thing's for sure: things are changing. The traditional dominance of the US dollar is being questioned as new players enter the field. Cryptocurrencies, for instance, have emerged as potential alternatives, offering decentralized and borderless financial transactions. China's clout is growing, and it's no longer content with being just a passive player in a US-dominated system. The Chinese yuan is increasingly being used in international trade, and China is making strategic investments worldwide to bolster its economic influence. Other emerging economies are also flexing their financial muscles and demanding a greater say in how the global economy is run. Countries like India, Brazil, and Russia are pushing for a more balanced and inclusive financial system that reflects their growing economic power. The US dollar's status as the world's reserve currency is being challenged, and the future of finance is likely to be more multipolar, with multiple currencies and financial centers vying for dominance. This shift could lead to a more resilient global economy, less dependent on any single currency or country. This shift could bring about more competition, innovation, and hopefully, a more stable and equitable global financial system. Financial technology, or fintech, is playing a crucial role in this transformation, enabling faster, more efficient, and more inclusive financial services, but it's also a journey into uncharted territory, and only time will tell what the ultimate destination will be. As we navigate this evolving landscape, the key will be to adapt and innovate, ensuring that the global financial system remains robust and inclusive for all.
So hit that subscribe button, ring the bell for notifications, and let's turn the page on a new adventure together. Get ready to experience books like never before, only on VBook 360. Like, comment, and share to support the channel and keep the video magic alive. Thank you for stopping by. And remember, every video has a story, and every story deserves to be shared. See you in the next video.